Hi everyone, it's Jack back with another video. Today I'm going to be doing a stock analysis on AT&T, well-known name all around the world, absolutely giant in its industry, in telecoms, wireless communications, internet provider, satellite TV, you name it. Mainly in the US and Mexico, and also as of right now the owner of Warner Media and Warner Brothers after the acquisition of Time Warner in 2018. It's a really interesting company, known for its very high dividend and reliable payments, or not so reliable as we're going to talk about in a minute. And the company has experienced more than a few problems in recent years, particularly after that the two acquisitions of Time Warner and DirecTV has massively increased the debt load. I'm going to be talking about whether I think AT&T is investable today and if I'm happy with the fair value that I'll calculate. Looking at some metrics regarding the balance sheet on the left-hand side, debt is easily the biggest concern with this company by far. Huge debt position, one of the largest, if not the largest, I've ever seen for a company of this kind. $21 billion in cash on the balance sheet, which is a reasonable position. Just shy of $200 billion in debt for a cash-to-debt ratio of 0.11. Really poor position. In an industry that requires capital, this amount of interest payments is going to be really cause suffering in this company. Big red flag. The company is clearly mismanaged, and current management are taking steps to rectify this. Most of this debt came from two absolutely shocking acquisitions. One of DirecTV, which they took a huge write down on and has been spun off, and the other of Time Warner. And Warner Media resulted from this and will ultimately be spun off to be merged with Discovery, as I'll talk about in a bit. This cash debt ratio is not unacceptable, but the sheer volume of debt here at $200 billion is really concerning, especially in such a capital-heavy industry. Debt to equity 1.2. Again, this is a $167 billion company with $200 billion in debt. That is concerning. Not the worst you'll ever see, but not great. The debt is not particularly well covered, with a debt to EBITDA of just 3.53. All that contributes to the company being assigned an Altman score of 0.84, indicating this is a company that is in financial distress. Of course, Altman score isn't everything. AT&T doesn't appear to be in any immediate danger of bankruptcy, in my opinion. It generates a ton of free cash flow, around $25 billion at the last reporting, and it's managed its debts okay. There are huge interest payments, but it's managing these. This is definitely a concerning state of affairs. Profitability-wise, the company generates a 53% gross margin, and this trickles down to a 16.73% operating margin and 11.89% net margins. These are really strong for the industry and are allowing it to get away with such a high debt load and such a high rate of interest payments. But this is not a company. This is a company that is saddled by these debt payments severely. Return on equity and return on assets are not particularly impressive, in my opinion. Both these percentages are maybe at the lower end for what I would expect for this industry. Return on equity, I'd probably be looking for between 10 and 20%. So 12.12% is a reasonable return on equity number, in my opinion. And return on assets, I'd be looking at between 5 and 15%. So return on assets at 3.7 is not great, but this is a very asset-heavy business. They have a lot of fibre, a lot of telecommunications equipment. There's all sorts that goes into this. Essentially, AT&T is an infrastructure company, so a low return on assets is not a surprise here. Looking at some valuation metrics, the valuation here really reflects the company's financial situation, in my opinion. By pretty much every metric, AT&T is absolutely dirt cheap. Price earnings of 8.66 and a forward multiple of 7.65 are not only very cheap versus the wider industry, but are both far below the S&P 500 averages, indicating significant discounts to the average S&P 500 company. Price to free cash flow of just 6.77 is very, very low. As you can see by the versus history numbers across the board, it is not only very cheap for its industry, but it's cheap. This is about as cheap as you can pick up AT&T stock in recent memory. Now trading around $23 a share. This has been on a kind of long-term decline. I think it's down around 50% over the last 5 years. This is definitely a company that's struggling. The burden of that debt load is causing it to struggle. But if they can manage to turn it around, which management is trying to do, this is an incredible opportunity. Again, just 7.5 times forward earnings. That is so cheap compared to the forward earnings of the S&P of around 20. And this is a reasonable company with some tailwinds, not just entirely headwinds due to that debt. When working out a value to pay for this company, it must be calculated as a sum of all its future cash flows, discounted to the present. AT&T has very strong free cash flow, as noted earlier. It's just no surprise that over the previous 10 years, they've been growing at 4.3% despite all the problems. It's grew at 4.3% on average for the last 10 years. Over the last 5 years, 7.1%, and in the last year it was down 7.6%, but I'm not going to ding it too much for that. I believe that going forward, a conservative model will be to keep this 4% free cash flow growth rate with an 8% discount rate for the long-term return to the stock market. I believe that AT&T has enough headwinds, the growth of 5G, the wider digitalisation of the world, and the growth of the Internet of Things. Internet is now as much of a needed utility as water in your home or electricity. So AT&T is well positioned to benefit from this. I think 4.3% free cash flow growth is fairly reasonable for this business. And using this number with today's stock price of $23.91, we get a fair value of $48.66. So over 100% upside, a nice margin of safety, and you can see the sheer discount of this stock. It's extremely discounted based on today's value because of that huge debt load, and crucially because of the loss of the dividend. So what I'm seeing here is a cheap company that has a ton of problems. What I need is to see is management addressing these problems well. One of the first things they're doing is they're spinning off Warner Media to merge with Discovery, creating a standalone company combining both these operations. Warner Media will be a real powerhouse of the industry. You look at these brands: Discovery Plus, HBO Max, Warner Brothers, CNN, HGTV, Food Network, TLC. There's a ton of big brands here. Eurosport in Europe is a big brand. Adult Swim, DC, of course. There's a ton of big brands here. 0.2 for every share of AT&T stock, you'll get 0.2 shares of Warner Brothers Discovery. AT&T shareholders will own about 71% of the new company, and Discovery owners will own about 23%, I think. This is a reasonable thing to do, in my opinion. They need to get some cash on the balance sheet to pay down debt. This is a sensible thing to do. Get rid of a small amount of a business, merge it with a rival, and create a compelling offering with a lot of bundling capabilities. And if these two are combined in any way, this really will be a compelling offering compared to the rivals like Netflix and Amazon Prime and whatever. So I really like this move. So the most recent news and the most important news for AT&T is that it's cutting its dividend in half. This is absolutely huge news for AT&T. If I saw a company, I don't really care how cheap it is. If it's got a 0.11 cash to debt ratio and $200 billion in debt, I'm absolutely not interested in it. That is until this news. In my opinion, a majority of AT&T shareholders valued the dividend far higher than the company's future prospects. And this is fair enough. The company's future prospects are kind of dwindling at the minute. I think this is the first time in a while that management are starting to make sensible decisions. Ideally, for the future of the company, the dividend should have been cut entirely to pay down the debt load. But there is some appeasement of shareholders needed, of course. Spinning off Warner Media and cutting the dividend shows a commitment to the 5G and infrastructure spending and refocusing the business on the core, essentially, the telecommunications business, and trying to shed these costly acquisitions that have caused AT&T to get where it is, shed the entertainment business, which is going to be a drain on cash flow. These businesses, streaming is an expensive business, content is an expensive business, and they're going to be a huge drain on cash flow, as we've seen with the likes of Netflix. I think this is a really great thing. This is exactly what a company should be doing if it's got $200 billion in debt. I cannot abide a company that's content with being in this amount of debt, continues to pay its a heavy dividend of what would have been 8.7% yield, I think, which is just ridiculous. Starting to pay down this debt in the near future, as they're going to be doing with the money from the Warner Media spin-off. The absolute best decision to produce a sustainable business, and in the future a sustainable dividend. I don't think dividends are completely superfluous. Personally, I would rather not have a dividend. I'd rather them invest the money back into the business. Dividends are not a tax efficient mechanism, and the money will be better spent on share buybacks, even in my opinion, which is a much more tax efficient way. But of course, income investors will think different on this, and one day I will be an income investor when I approach retirement. So overall, I think this is a really, really wise move from AT&T management, and I hope they don't increase the dividend too much once the debt comes down a bit and the interest payments come down a bit. I think this is completely sensible. Overall, I think AT&T is a good business that's had some really poor mismanagement over the recent years. Management are really starting to turn it around. The introduction of the new CEO 2 years ago. They're kind of acknowledging the past mistakes, especially Time Warner and DirecTV acquisitions, and they're trying to rectify this by refocusing the business, paying down debt, cutting the dividend, which I just think is absolutely huge. And I really like where AT&T is going. I still think it's too risky for me at these prices. Even at an 8 price to earnings, that debt load is just absolutely crippling. I'm not really willing to invest in this company until I see that debt load come down, because management's saying they're going to do it and actually doing it. are two completely different things. If they can start to get the debt load coming down over a few quarters, then I will consider it, because I think it's a great company with some tailwinds with the growth of 5G, the growth of the Internet of Things. I think this is a strong company that has the potential to be really strong if they can pay down that debt load. I just think it's a bit too fragile at the minute and a bit too hard of an investment. I think there's a lot that could go wrong with it. If they cut the dividend further in the future, I think there could be a decline in stock price because, again, income investors that have held on, I think they'll be in a lot of retirement accounts. I think there could be some short-term pain for longer-term gains. That being said, this is not financial advice. It's just my opinion. So if you want registered financial advice, you speak to a registered financial advisor. And of course, do your own research. If you want, comment down below and talk to me about your opinions on AT&T. I'm happy to be disagreed with and promote some sensible conversation. And if you're enjoying the videos, let's like and subscribe and get the channel to grow. Thanks.